So what happens if I have a cash value life insurance policy and I can't pay anymore? I had these plans to fund it for a long period of time till a certain age, and life happened, meaning something happened to me, I lost my job, the economy went down, whatever it might be, and I cannot pay anymore. I planned to fund it for 10 years, and now I only funded it for 2 or 3 years, and I have to stop or pay a different amount. What are my options? What's going to happen to the policy? Will it lapse? Good questions to ask. Let's show some options. So, 1, if I cannot pay into a policy anymore, remember that when we first construct the policy, going back to the policy design, your money can go where? Premium or the PUA component. The PUA component accelerates the cash value immediately and does put one in a position where if life happens, the policy can pay for itself sooner. You're going to see that come up in one of the options here. But the main point here is the PUA piece is optional. So we often refer to a 10/90 split. For example, if I'm paying in $30,000 per year, I can, with a lot of the top companies, put my minimum premium at $3,000 per year. So the PUA piece is often optional. I'm not required to pay that like I am the base premium. So if I only have a minimum premium of $3,000, where I was paying in $30,000, that opens up a ton of flexibility, loosens the vice grips, so I know, hey, I can easily commit to the minimum, doesn't feel like a burden, I can't pay anymore, can I not pay the full amount, or can I easily eliminate that PUA and be able to still pay the minimum premium? So that's one option, I can easily pay just the minimum. Option 2, the policy can often fund itself if I've had it in force for a couple of years and funded money into PUAs, and I didn't borrow everything out. The policy can often fund itself through dividends and interest. And what this means is I'm going to take the dividend payout, which is the surplus, and also the guaranteed interest of 4%, and have that on the policy pay the minimum premium, and then the excess is reinvested into cash value. You're going to see an example of this as well. 2, the policy can fund itself through a loan. If you have a policy and you read through the application or your full contract, you'll likely see a provision in there that reads automatic premium loan or loan protection rider. Overloan protection is usually what it's referred to, or automatic premium loan. What this does is, in the event that I miss my premium or I can't pay it, the policy can loan from itself to pay the premium. And this can sometimes be effective, especially if I want to pay that loan off later down the road. And remember, if I'm loaning from the policy, yes, I'm taking debt against it, but at the same time, I'm depositing money. Think of it this way. If I'm beyond the first 2 years of a policy, this is where this can work nicely, is your minimum premium, beginning year 3, typically does build cash value. So if I take a loan to satisfy a $3,000 minimum premium, what'll happen is I'll take a loan, my cash value will debit $3,000, and then it will pay that minimum $3,000, which will, guess what? Credit my cash value, and then continue to yield dividends and interest as if I had paid it in the first place. So if I pay that loan off later, whether it's during the year or way down the road, I will see my cash value restored to what it would have been as if I had paid it on my own. Then I've got the reduced paid up option. So this is good to be aware of. It's kind of like a, how can I put it, a kill switch with the life insurance policy. Doesn't kill it in the sense that it terminates it, but what it allows one to do is eliminate the premium altogether. Typically, we cannot do it during the first 7 years. It has to be after year 7 to prevent a MEC. Has to do with that 7-year test. But once I do this, it eliminates my base premium altogether. So then, typically when we hear option 2 become available, or even option 3, hey, here are ways to allow the policy to pay for itself. Well, this reduced paid up option cuts the premium off altogether. So premium is not due. The advantage to this is now all of my dividends and interest do not have to pay a premium before they're kicked back into cash value. they're all kicked back into cash value instead, which is nice. The disadvantage to this, we refer to it as a kill switch. Once we kill it, once we turn this option on, the reduced paid up, there's no going back. So we can, with the reduced paid up option, once that's exercised, we can no longer pay money into the policy. We can borrow and repay, but no more additional PUAs or PUA, no more additional premium dollars or PUAs can be added to the policy. So let's look at an example here. We have a policy on a 35-year-old male. On the left, funding $30,000 per year for 30 years, up until he's 65. If you scroll down, you see it grow quite nicely. He's paid in $900,000 and he has almost double that in cash value. Looks great. Now, the option to your right, to my left, is the life happens scenario. So what happens if I can't pay? Do I lose my money? No. We see 2 years go in. I can continue to fund thereafter. Maybe I stop and go. I don't have to pay nothing forever. But what happens to my cash? Continues to grow. You see a death benefit reduction in year 8 and also in year 11. So we're going to demonstrate why that is on our other training program. Just for compliant reasons, we've put it behind that wall to make sure everything remains compliant. But the overall message here is a policy can continue to fund itself. If life happens, am I going to lose my policy altogether? No, it will continue to produce dividends and interest and can continue to grow. The big if is if it was designed properly. Was it set up with a minimum base premium, which minimized the drag when I did not have to, or when I could not fund the policy anymore? So, know this was a lot of information. Feel free to reach out with any questions. And as always, hope this was helpful. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.